You spot the perfect setup. The price drops down to a rock-solid level of support, you hit buy, and almost instantly, the bottom falls out. It slices straight through the support line, triggers your stop loss to kick you out of the trade, and then, infuriatingly, skyrockets in the exact direction you originally predicted. You aren't cursed. This sequence of events is a built-in feature of the system. Those trend lines, double bottoms, and standard support zones you spent hours memorizing function as bait for a much larger trap. In this ecosystem, your money is called liquidity. Massive players require your everyday retail orders to fuel their own positions. The standard rules of trading were designed to weaponize your own psychology, ensuring you place your money exactly where the big players need it to be. The market makers have evolved. Massive algorithmic systems and central banking institutions now dictate every major price movement with programmatic precision. The charts you stare at aren't displaying random fluctuations. They are printing a highly structured algorithmic language. Trading is a zero-sum environment. For a massive institution to generate extreme profit, an equally massive amount of retail money has to be lost. But because these institutions rely on algorithms, they have to follow strict programmatic rules. They cannot move silently. They leave footprints. Escaping the cycle of losses requires you to unlearn everything you've been taught and start tracking the precise footprints of smart money. There is a golden rule in institutional trading. Your stop loss is my entry. A bank wanting to buy a massive position can't just click a button. They need to find thousands of people willing to sell at that exact moment to fill their order. Market makers intentionally hold price in a range, creating obvious support and resistance levels to build confidence. The dollar signs mark vulnerable retail stop losses. Algorithms then drive price past support, triggering those stops, and instantly scoop up the panic sells at a steep discount. Once they have inventory, the aggressive move begins. Looking at this chart, you can see the break of structure, the exact moment the swing low is violently broken by a solid candle body, confirming the trap has snapped shut. It costs money to manipulate that initial drop. To clear those temporary losing positions, algorithms bring price back to the scene of the crime for mitigation. You can pinpoint this exact algorithmic bookkeeping right at the final buy-to-sell candle before the massive drop. These unpredictable spikes and crashes are the visible signs of a highly ordered ledger violently balancing its books. This stop hunt trap doesn't happen in isolation. It operates continuously across distinct phases: accumulation, markup, and distribution. Notice the initial tight, boring range. That quiet consolidation is where massive institutional positions are secretly built up over time. When they finally trigger the move, it happens so fast it leaves behind imbalances. These are literal gaps in price where only one side of the market was offered. The algorithmic code demands efficiency, so it is magnetically programmed to eventually fill those specific gaps. Spotting these imbalances and tight accumulation zones proves institutional sponsorship. It shows you exactly where the heavy machinery is operating, letting you filter out the random market noise. To escape, identify a sponsored move. This chart displays price action backed by massive capital, breaking structure to confirm the range low. Tracing that break backward reveals the point of interest, the shaded area where the bank placed its massive order. Instead of trading the breakout, wait patiently for price to return to that entry zone for mitigation. Entering here allows a tight stop loss above the range high. If price crosses it, the bank was wrong, and you exit safely. You stop reacting blindly to retail patterns and start placing your orders exactly where the institutions are forced to balance theirs. The math flips in your favor. This strategy requires an uncomfortable level of patience. A valid, high-probability setup might not appear for days or even weeks. Stick to the new rules. Never buy blindly at retail support. Never sell blindly at retail resistance. Preserving the money you have and assessing the danger of a trap will always be more important than the anxiety of missing a trade. Trading mastery requires you to look past the illusion of the chart and trade exactly alongside the architects of the matrix.